A very good evening, everyone. Welcome to Admiral Markets. We're going to take a look at a very interesting topic, trend definition at its best. And I think that it's a very, very important topic, in fact, because trading with the trend is definitely one of the things you want to learn at first when starting out with trading. And for probably a very long time, I think it's one of the best ways, in fact. So we're going to talk about how to define a trend and how to trade it, but more on that later on. Before we discuss this, the risk disclaimer explaining that trading for exchange and global financial markets is considered high risk and may not be suitable for all investors. Please seek the advice of an independent financial advisor for more information on that. And the webinar is for educational purposes only. So we thank you for your attention on that. And we welcome you once again to this webinar hosted by Admiral Markets. So my name is Chris, by the way. Tarantula is here as well, and I believe also our special guest, Michal, and he'll just share a few words, and then we'll talk about trend definitions. Good evening, Michal.
Good evening, guys. Thank you very much for such lovely introductions. Once again, very nice to speak to all of you here today, especially to you, Chris, and Tarantula. Thank you very much for such a lovely introduction. Once again, my name is Michal Olachov. I'm a client relationship manager for Admiral Markets, which means my initial job is to create the best possible trading environment for all of our traders. Here you can see my email, my Skype, my LinkedIn, and also the email for Trading Camp. We still accept applicants, so if you're interested, please give me a nice line. Also, I wanted to let you know that from next week, when it comes to the first part of the presentation, which I'm doing, we'll be changing it a little bit. So if you have any ideas or any topics you would like us to discuss, you can always write to mo@admiralmarkets.com and we can have a nice conversation about it. It's very nice to finally tell you all about the small changes because we have a very nice crowd here today. I'm pretty sure we're going to have a lot of very nice suggestions. I also see that a lot of people who are here today are our clients, but of course we also have a number of people that are clients of other brokers. And I extend my warmest welcome to all of you. I hope you're going to enjoy this webinar very much. But that brings me to a certain point I wanted to make in today's presentation. Why do we choose one broker over the other? What sets apart one broker from the rest? And there are a number of factors that you consider before you make a decision. Before you decide which broker you would like to trade with, you almost certainly will consider the following. You'll consider the spread, the platform, the deposit methods, amount of instruments, variety of account types, and so on and so forth. You choose the factors that are most important to you, and you make a decision. But of course, none of those factors matter if the key factor is missing. And I'm pretty sure all of you already know which factor is the most important. I'm talking about trust, of course. No matter how great conditions are, it all means nothing if you do not trust a broker. In fact, none of the factors even exist if you do not trust a broker who advertises them. Investment is a very interesting, very tricky part of business. And of course, those people are going to handle your money. So you must trust them completely. This is the amount of trust you must have in your broker. If, say, a broker with a dodgy reputation advertised 1 pip maximum spread, would you believe such a broker? I don't think so. Most likely, the spreads are higher. And even if they were that low, you would not probably be able to withdraw your profits or something else would probably happen. So you see, the trust is the main factor and it's the most important criteria. Trust, of course, has been a critical issue over the past few years, especially in the financial sector. And if you would never buy a product from eBay, if, say, the seller had less than 100% positive feedback, why should you settle for something less when it comes to a financial broker? After all, you entrust your broker with substantial funds, and the level of trust should also be quite substantial. So how do you choose a trustworthy broker? As most of you have probably noticed, there's not a single place on the internet that will present you with 100% accurate data. And more often than not, brokers' ratings really depend on the amount of money said broker is willing to pay to the website. So here are a few things to look at. First, in the financial world, there's always someone watching. In this case, I'm talking about the regulators. In order to receive your license, you must comply with strict regulations, and more regulators you're allowed to watch you closely, more secure you are. Admiral Markets, for example, is licensed in Europe by the FCA, and we have a passport from MiFID. Admiral Markets has recently received an FCA license in UK and has been regulated by Australian Financial Service License also. So being licensed, of course, is very important. But Admiral Markets is not the only broker that is highly regulated, and there are many brokers that are authorized on many continents as well. This is why we decided to go a bit further. In the Facebook era, we at Admiral Markets decided to go a bit beyond for our customers. And rather than sharing a transaction, we want to establish a personal relationship with all of our clients. Our policy is to provide a personal account manager to each of our customers. If you have a real account with us, if you have a demo account, or you participate in football, there is a person in our company that can help you out in your own language. Not a member of a support team, an actual person that is responsible for your account from the time you registered in the company to the time you decide to withdraw all of your profits. So if I can illustrate it with a picture, this is the size of our company. We have presence in more than 40 countries with physical offices in more than 40 countries. And this is our customer service, a friendly little shop that have known you since you were little kids. So personal and friendly. I like to think of myself as a great example. I work with customers in UK and Ireland. And if you're watching this webinar from one of those countries, chances are me and you have already spoken. At the start of the presentation, I have shared my email and phone with you, as well as my LinkedIn and Skype. So that makes me a real approachable person. You can always go on LinkedIn and find my profile there with good recommendations, and you can always leave one if you feel like it as well. So we at Admiral Markets believe that in the modern era, trust is the main virtual currency. We conduct our business in an open and friendly manner, and we think that before we get your business, we must establish a relationship with you. So once you feel we have won your trust, you can register an account with us, only to find out that we have spreads on major pairs as low as 1 pip. We offer managed trader 4 and 5. We accept bank wire payments, card payments, and Skrill. And we give you a variety of accounts to choose from, standard, professional, all sorts of managed accounts, and special CFD. So register an account today and meet your personal account manager in just a few hours. To him, you'll always be a #1 most important client. Thank you very much for listening for me today. I'm pretty sure Tarantula and Chris have a great presentation ahead of us. So I will now pass the floor to them. Thank you once again.
Thank you so much, Michal. That's great always to hear from Michal. Has always very interesting items to share with us. And I sure you agree that was great stuff. We're going to take a look now at today's goal of the trend definition, how to define the trend. And we're going to take a look at several things. What is a trend? How do we define it? What difficulties we might encounter? What tools could we use? And how do we actually trade it? So that's all coming up. Well, first of all, I even want to start even from the very basic, why trade with the trend before we even define it? Well, in general, I think we can say that it's just easier to spot trading opportunities, all right? Because reversal trading or range trading, they do have their quirks, and I would say are known to be kind of environments where traders with a lot more experience tend to succeed, right? So it's easier to also find trades that succeed, better reward to risk, but also easier to manage the trade because the targets are easier to define and there's a bit more time to think about the development of a trade. Normally, you don't see a reversal all of a sudden out of nothing. You can see it a bit coming, and you have a bit more warning signs to exit a trade maybe. So there are definitely good reasons why you want to trade with this, with the trend, right? And if you are trading with the trend, you want to be a realistic with the trend trader. And how you can be a realistic one is explained in this PowerPoint. Furthermore, it is also important to know that only knowing what the trend is, of course, is not going to be enough. There are definitely other things you want to consider. Knowing the trend is great because we need that directional guidance to have an idea which signals could be good for trading in that direction. All right. If you would not have a trend bias, then it would get maybe a bit confusing. But other things you definitely want to consider are filters. What could be blocking the trade from developing? What could hinder that trade? Is there divergence that could hinder it? Are there weekly trend lines? Is there a weekly top, daily top, major pivot point close by? These kind of things you can think about. Even if we are in a trend, these types of characteristics could block the trade from developing because no one wants to buy right in front of resistance. No one wants to short right in front of support, usually speaking, even if you are in a trend, unless you're talking about a specific breakout situation. Now, once you have done that, you also want to consider, is there an opportunity to trade, considering your trading plan? What would be the trigger for you to trade it, and what kind of methodology can you actually enter? Are you looking for a confirmation? Are you looking for a pullback? Are you looking for a break and continuation? And these things are definitely there to consider. But we're going to focus on trends, and Tarantula is actually going to talk about what is a trend.
Yeah, hello Chris, hello everyone. Yeah, I will explain in short what trend is, and in one of our future webinars we will give you some trend following systems. They will be very important for beginning traders and for some advanced users, because we will concentrate on higher time frame trading, which is very important, as we can see, because these circumstances of what markets have become, just we need to take account higher time frames, because trading on lower time frames can yield a lot of risk. As you can see today, well, I know I told you all to buy the dips, and I was right, but you know, this exceeded my expectations. This is too much of a move to the upside, and today I just couldn't trade with the trend on euro dollar, because we didn't have any substantial retracement. Well, it would be the best if the trend like this will be every day, because then we would know what to do. But basically, what happens today, this was a direct rise. This was not a clear trend, and I will explain again what trend is and how what we should know about the trend. So trend is a series of price movements which determines the main direction. So that is my definition of a trend, and that is the pure truth. So it's a series of price movements which determines the main direction. That series of price movements determine the main direction. In its sense, it can be upward, it can be downward, and it can be sideways. When I talk about trend, I won't say that sideways trend is a trend. Sideways trend is called a ranging market. So we do not want to define a sideways market as a trend. It's a ranging market. Uptrend is a series of higher highs and higher lows. Downtrend is a series of lower highs and lower lows. So I remind you, this is the most important thing to how to define a trend. Uptrend is a series of higher highs and high lows, and downtrend is a series of lower highs and lower lows. Trend exists on each time frame. So if we open M5 or M15 or 1 hour, 4 hour, daily, weekly, monthly sequence, we can see that trend does exist on each time frame, But the thing is, the bigger the time frame is, the stronger the trend. So if we want to talk about intraday trading, we will of course define our trades on 4-hour time frame, 1-hour time frame. If we want to trade intra-week, then we will define daily trend. So there is all this is all now a beginning. This is only a definition of what a trend is, and now we will show you later how big stop loss should be for each time frame, how to enter on different time frames. So this is the most important thing: uptrend and downtrend. And let's say sideways is a range, so we don't take sideways trend as a trend. Trend is something that moves. The sideways range, it's accumulation, it's not distribution, so that cannot be treated as a trend. So the two most important definitions of trend are: the trend can be in uptrend or downtrend. Ranging market is completely different thing, and we do not take into account when we trade a trend. So we always trade either uptrend or downtrend. We don't like to trade ranging markets. We talked about it, because ranging markets can just burn our account. It's very difficult to trade. So we just don't know when a range will begin, right? So let's concentrate on trend. The next thing I want to tell you is how we define a trend. So within any trend, there are other smaller trends that make up the whole trend. That is called by thrust and pullback action. That's why we use trend lines, channels, EMAs, or MACD. To define a trend, we can just take a look at a picture, so we can see if there are substantial higher highs and lower highs, then we can say it's uptrend. If we have substantial lower highs and lower lows, then it's a downtrend. We can spot easily the trend by drawing a trend line using EMA channels or MACD. Uptrend is series of higher highs and higher lows. Downtrend is series of lower highs and lower lows. Sideways trend, we don't say it's a trend, it's a ranging market, and it's a common phrase. So if we want to see what the trend is, we need to see thrust pullback action, or it is called by some traders, analysts, and some other people who trade, it's called zigzag action. So I have included a picture of a good zigzag action. This is called zigzag, and zigzag defines a trend. There is also an indicator called zigzag, which will draw lines to define peaks, lows, and bottoms, but you don't need that. You just need to see it. You can see it by your naked eyes. So thrust pullback is a trend. And if you can see in this picture, this trend is made by other smaller trends that make up the whole trend. The first part of thrust and pullback is an intermediate trend. The second portion of thrust and pullback is defined as medium trend, and the trend line is defined as a whole trend. Remind that. So we have three parts in this picture. Intermediate trend, that's an immediate trend. Then medium trend, that is the second part of thrust and pullback, and the whole trend line makes uptrend. So that is the simplest definition of a trend. I will show you how you can define a trend by using channel or by using MACD. EMAs are different kind of thing. EMAs just require a special webinar about EMAs, because there are many combinations with EMAs and many number combinations with EMAs. So it would be so good to talk now about EMAs. Next thing is MACD and channels. So how we can define MACD and channel trend. As you know, I'm a very big fan of MACD, and this is just a part of what we can do with MACD, because basically MACD is a momentum indicator, but we can also define it as a trend capture indicator, because it captures a trend in each time frame. And this is just its introduction and the most important aspect of MACD, how the trend is defined by MACD. And the second thing is a channel. So the first picture defines, you can see that we have a zero line. Zero line on MACD is called waterline. When green line and white line are above waterline, we say that the market is having a momentum. So when green line is above white line and those both lines are above waterline, we say that we have momentum. Okay? When we have thick building bars above waterline, so thick building, not these thin bars. I'm talking about thick blue bars. We say that MACD and the trend is an uptrend. So we need to have thick building bars, we need to have a momentum. So we say that we have both trend and both momentum. When thin bars start to build after thick bars, we say that we are still in uptrend, but we are having a retracement. So these thin bars define a retracement. So this is not a change of the trend yet. This is just a retracement. And now when we see that green line has crossed below the white line, and we have thick red bars below the waterline, we say that we are in downtrend, but we not have a momentum yet. The momentum is only spotted when both of those lines are below the waterline. Okay, now we are talking about trend. So the trend starts with a cross. Remember that on MACD the trend starts with a cross. It goes up with a thick building bars above waterline. It goes down as retracement with thin bars above the waterline. It changes trend when green bar crosses below white. When green line crosses below the white line, it's then a downtrend. And momentum is when both of those lines are below the waterline. Then we say that we have waterline momentum in a downtrend. Retracement on MACD is defined by thin bars. In our now I have questions I need to answer. In our MT platform we have only one size of the bar. Yeah, I know that. By default on MT4 platform is installed all MACD. It's called MACD, it's a standard MACD indicator. You need to find a MACD two-line indicator which prints both blue and both thick and thin bars. I think it's called MACD two-line, but you can find it on forextsd.com. So go to forextsd, they have a nice source of indicators. So you can just Google MACD two lines, but be sure to find MACD two lines with both thick and thin building bars. Okay. You don't have this indicator included on your platform. You need to Google for it. So this is how we define a trend. This is the simplest way and the most important way of using MACD. Of course, when we use MACD, we need to use it on multiple time frames, because a single time frame doesn't tell us anything. We need to use it on multiple time frames. Okay? So you know now how trend is spotted by using MACD. and this is the truth. I don't know what other analysts, what other traders say about MACD. I know that I use MACD this way, and this is the truth. And now I'm telling you things which are usually, you know, people pay to know for these things. So this is a very, very important aspect for MACD. This is how professionals use MACD indicator. Okay. Now the second part is channel trading. Channels basically defined. Yeah, previous slide. Yeah, we have channel also that can define a trend, and you know, channels are defined as basically as we have inner trend line and outer trend line. So we have lower and upper trend line. When we draw lower trend line, we have a nice building lower line, lower part of the channel. When we draw upper line, then we have a complete channel. So basically, it's much easier to include equidistant channel tool as we all have on MetaTrader 4 platform. So by using channels, we can also define tops and bottoms and whether the trend is going upwards or downwards, or we have a sideways market. So this is the channel, and you see the channel also defines the trend. So you can see peaks and bottoms, you can see highs and tops, and you can see how those channels also can define a trend. In this picture, we have a nice example of downtrend. Okay, downtrend. And now, Chris, I think that you can continue with your part of trend spotting.
Yeah, this is just a slide basically showing indeed if you just look at higher highs and higher lows, it does help, of course, obviously, but there are some practical issues. That's why a trend channel, as Tarantula was showing, is a great solution for that, because not all the time if you have a lower low that technically is a lower low when you just break it by, let's say, more than 15 pips, because anything within 15 pips can still be considered double top or double bottom. You know, if you use that as a strict guideline, then maybe, oh, I lost the presentation there. One second, folks. There we are back. Then, strictly speaking, you could have a lower low here, but obviously you can see if you put it in the context that this is probably retracement, and some of these fractals that get broken, you know, are not maybe as significant to the trend, and technically you do have a lower low. So this is just to give you an idea of that. And fractals, by the way, are just a good idea, of course, a great easy way to see where tops and bottoms are, and just an easy visual tool so that you don't have to strain your eyes that much. Now, here, if you group them together, you can obviously see that you have that continuation to the upside, and except here, which means that we had a bit of a triangle, right? In that case, because what happened here, we had a lower high, but we also had a higher low, and then we finally broke out to make the higher high and continue with that upside. Now, sometimes you'll see situations where you get a bigger retracement. Is that a retracement or still continuation? Or do you sometimes get a reversal? Those questions I'm going to answer, or we are going to answer a bit later on. But just using that as a definition definitely will give you a great idea of what the trend is. And sometimes you will have some toss-ups, not toss-ups, but gray areas where you want to maybe realize that is this a big retracement or a total reversal. And we'll give you some tips how to look at that. This is the 4-hour chart in the euro, by the way. So some practical problems. Actually, I already talked about it a bit. First of all, not being aware of the concept of the trend. That is not you, because you're here, so you know exactly what the trend will be, but not having a precise method of defining the trend, right? Not having not only precise but consistent, maybe changing the definition from time to time, and every experience you encounter, you might change the trend definition because the last time it did, this worked better, or the time before that worked better. So that usually is not a good idea, because you want to have a consistent approach and also precise approach. Furthermore, I do think it's mentioned twice, which is a mistake. I wanted to mention something else. Our mind sees reversals. I have a tendency that traders do like to look at reversals because I think most of us are just, at least in my humble opinion, are kind of geared towards finding those reversals. And not often do reversals happen, and a lot of signals have to kind of build up before usually they play out. I wanted to mention something else about trading psychology. I think it has to do with chasing the market that I wanted to mention, and but not sure. I forgot to change it there.
There are also, there are some difficulties in trend trading. The most common difficulties is to define a trend, and those things I mentioned in this slide. Trading psychology, trading mentality, technical problems, fundamental problems, and placing stops and early exits. So let's say how we define a trend. So I told you already how to define a trend. Is the easiest way. If you trade intraday, it's better to define a trend on 4-hour or on 1-hour time frame. So first of all, you need to let your mind consolidate. If you want to trade intraday, you don't want to take only weekly and monthly and daily charts. You need to have a look at 4-hour chart, and your entries should be at least 1 hour or 15-minute chart. I prefer 15-minute entries. So I think that one of most biggest difficulties the beginner trader faces is that each of you who are beginners probably has a lucky start with much winning trades and lots of profits. And if you read a book by Paulo Coelho called The Alchemist, it's the law of cosmos. When you begin something, probably in the beginning you will be lucky because the universe will wish you luck. So that is only for beginnings. But the problem is that you as a new trader you are very unaware of the reasons for your success, and you will probably continue to implement the same strategy until you start losing your money again. And what a new trader does not realize is probably that the market environment has changed for that particular market, and it's not longer a trend. It's probably accumulation, it's probably a consolidation with many whipsaws, and that is when we start to lose the money. When the market was trending, we can have loads of pips because we were riding the tide, and we were going with the flow. And we don't use much of trading psychology, right? Because we had yet to encounter a serious setback. But as always, and that is unavoidably, that currency pair will eventually stop trending at one point, and then traders who don't know the trend has changed will lose money. So you probably often look for attempt to find a solution by looking various systems on the internet. And I know that is the most of you did that, and maybe the most of you are doing that or have been doing that. And that is wrong. You need to find one trading method, one particular trading method. If your style is trend trading, then go with the trend. Just learn how to define it. So basically, we talked about it from beginning trader to developing trader, what happens when you're a beginner, novice, and so on. But next thing which is also important is trading psychology. Trading psychology is trading fear and greed, okay. And fear and greed probably will switch places each day. one day you will be very feared, and the next day you will be very greedy. Well, that is a major setback, and that setback we can define it because a trader might not fully trust the trend or the reason why it is important. So you probably do not trust your own definition of the trend, or you just do not have the faith in your trading strategy or system. Trading mentality is another problem that probably occurs you many and multiple times. So we already talked, if you are chasing the market, then the best trend spotting will not help you. If you want to be a good trend trader, you need to keep focused on the trading with the trend and picking the right moment to entry. If you are not sure when to entry, open your high time frame and try to spot a bigger pullback. Not a small pullback, you need a bigger pullback. Next thing is also known as technical problems or whipsaws. We have seen many whipsaws during the last couple of weeks on some currencies. Aussie was trending fine, cable had a whipsaw yesterday, also euro dollar had a major whipsaw yesterday. We saw what happened to dollar. Dollar was gaining strength prior to the release that US debt ceiling agreement has been done. Then after the agreement has been signed, what happened? Euro dollar, cable, and Aussie. Aussie is normally, it jumped because it was already in uptrend, and you see how much they jumped, 200 and more pips. But the biggest problem is whipsaws that we had for last 2 weeks. And probably what many traders faced is they open position based on a trend, the price goes 20 pips in the profit, but suddenly changes and hits break even. And that happened, I think, many times. Even if you trade on higher time frames, it could have happened because the price was violently jumped up and down. That's called a whipsaw. Then there are also fundamental problems, news releases and world events. News releases such as US debt ceiling agreement, and world events such as, let's say, earthquake. If you remember earthquake in Japan last, I think it was 3 years ago, what happened is that many traders lost the money due to sudden strength of the yen. Also what can happen is that you place probably, you don't know where to place stop loss. We had a webinar about stop loss yesterday, so you don't know where to place stops and probably early exits. You just don't know when to close the trade, when to take the price. It depends on your time frame. If you're trading on higher time frames, then you need to take account that price can move 100 to 300 pips. If you trade lower time frames, let's say 5-minute, 15-minute entries on 1 hour, 4 hours, then it's okay to have a 30-35 pips win. But if you, or 50 pips if you trade on 4 hour. But if you trade only 5 minutes and 1 minute, then 7-10 pips is okay. But let's say that 10 pips is 12 pips is maximum stop loss you can have on those trades. So basically placing stops and early exits is very big problem in trend trading, but correct stop placement and exit done by a setup time frame, that is what you should do. So I will show you later how to take profit from higher time frames.
Great stuff, definitely. And I'll continue now with a bit more of the trend definition, what I wanted to share, in fact. Tarantula has already mentioned trend channels, and I'll just share my point of view, and then we'll wrap up the trading, the trend definition PowerPoint. key with the defining the trend is to read the market structure, basically, because what you're trying to look at is the underlying current. Tarantula was already mentioning the different levels of trend there is, the long term, the intermediate, the short term, so that you can see what the dominant direction is that you want to trade it, and wait maybe for the lower current to finish that trend or its correction, and depending on the time frame you look at it, and continue with that dominant view. By looking at it that way, it offers you a good, good incentive, good way to join the trend, and it's basically would be the equivalent of when swimming with the stream instead of trying to swim against it. We all know that swimming against it is a hell of a lot of work. It's very difficult as well, and you won't get too far. Swimming with it is a lot easier. You'll swim a lot further and faster and with a lot less energy. Also key is to distinguish the most important tops and bottoms and fractals so that we know we're able to distinguish the trend in a bit easier way than maybe kind of deciding what is the trend every time we have maybe a smaller lower low. So how to do that? Well, using multiple time frames, definitely. One for trend, one for filters, for example, one for entry, maybe even 2 time frames for trends, although that could maybe be puzzling and giving a bit of a mixed picture. But if you are more used to multiple time frames, then looking at 2 time frames would be okay if you have that experience. For example, we'll look at the time frames actually in the next slide. The trend channels and trend lines, obviously, moving averages, Tarantula was saying indeed that it's a bit long to go into that. I do have one example of the moving averages I use in the trading room. We look at, or some of you look at here at Admiral Markets on Tuesdays, Wednesdays, Thursdays, and I'll show you why I use that. And fractals makes it a lot easier to spot. So let's dive into a bit more detail regarding the time frames first of all, and then we go into the other points. Oh, and also, as Tarantula mentioned, by the way, I forgot to mention it, but the oscillator indeed definitely also should be on this list. Good point. Time frames. Well, just I think everyone has an idea. Swing trades, you want to use a 4-hour and daily chart for the trend definition. Intraday traders might think of 1 or 4-hour or maybe even 2 hours, somewhere in between. Scalpers, 1-hour charts would be their main trend definition. And the position trader will probably look at maybe even weekly charts, depending on how long-term the trader is actually trying to trade. So you can see it depends on what type of swing trader you are. If you're more of an intra-week swing trader, you would be looking at the 4-hour chart. And if you're more of an intra-month swing trader maybe, or somewhere in between, maybe daily charts. So that depends. Oh, I can see that we first actually look at this. Sorry, I got the sequence mixed up. I'll continue later on. Let's take a look at how to trade first.
Yeah, well, this is directly connecting, and it's directly connected to a slide, a prior slide. So let's say how to trade a trend. I will show now. This is not a trading system, but this is the part. This should be the part of every serious trading system or trading strategy. Just let me. I will, guys. No problem. I will answer all questions later. Just let me finish with it. Maybe I know you have many questions. So, how to trade a trend? Trend is traded by multiple time frame analysis. I just cannot understand various systems over the internet, across the internet, that say trade solely on 1-hour time frame, trade on 4-hour time frame. This is not my logic, and this is how I do it, and this is how trading basically, no matter what kind of strategy you have, this is the basics of trading a trend. So we need to have a setup chart and entry time frame. Okay? because we talked 10 minutes ago about immediate trend, about medium trend, and about whole trend. So there are also trends within trends. So that is why we use multiple time frame analysis. If we have setup chart of 1 hour, we use 5 minutes for entries, and that is basically scalping method. Setup chart of 4 hour, entry time frame is 15 minutes, that is basically intraday trading. Setup chart of weekly, monthly, entry time frame is daily time frame. And by placing a daily, sorry, I will mute my phone. And by placing a daily entry, we basically trade weekly and monthly trend. So do you understand what I'm saying? 5-minute entry is for 1 hour trend. 15-minute entry is for 4 hour trend. Daily entry is for weekly and monthly. And that is how we base approximate stop loss and target price, take profit. Based on setup chart 1 hour, we placed our stop loss above last swing high, low, and maximum 35 pips. That is the dead stop, guys. If you are scalping, then on setup chart of 1 hour and entry time frame is 5 minutes, then you need to have in mind that that is the maximum of maximum stop losses. Usually your stop loss will be in between 15 and 25 pips. But for some, you know, sometimes we just need to place it around 35 pips. I'm talking now about approximate figures. If we trade intraday based on setup chart on 4 hour time frame, we place stop loss usually in between 25 and 35, 40 pips, let's say 40 pips. And maximum we should use is 50 pips, because we probably won't have such good risk to reward if we use a bigger stop loss. Then we need to find another pair which to trade. Don't stick just to one pair. We have other pairs to trade. Today I also traded CAD, Japanese yen, and I had two nice trades, two profitable trades with CAD, Japanese yen. Because I traded on a 4 hour trend. 1 hour was giving me nice potential setups, and my actual entries were on 15 minutes and 5 minute time frame. So basically, we don't have to stick to just dollar pairs. CAD, Japanese yen, Euro CAD, Aussie CAD, other pairs also. Targets are very important, and we need to see pivot points, but based on setup charts. So if we use setup chart of 1 hour, we will use hourly pivot points for target prices, because we use hourly pivot points because we use 1 hour time frame and we trade on 5 minute time frame. So our entry is 5 minutes based on 1 hour. Stop loss is based on 1 hour pivots on 1 hour swing highs and lows, and target price is based on hourly pivot indicator. If you do not have hourly pivot indicator, try to Google for it. You will probably find it, hourly pivot points. If our setup chart is 4 hours, then we need to use daily pivots and weekly pivots for target price. We don't use hourly pivot points if we trade daily pivots and weekly, because probably we will have a 10 or 15 pips profit maximum. We need to use daily pivots and weekly pivots because we are trading on 4 hour time frame using 15-minute entries. And for daily setup, we need to use weekly and monthly pivot points, and entries should probably be on and I suggest that on daily time frames. So we can put it daily. If our setup chart is daily, we can also trade on 1 hour time frame. I didn't write this on this slide, but you can also remember that if our setup chart is daily, we can enter on 1 hour time frame. but we will use weekly and monthly pivots, not hourly pivots. Remember, hourly pivots are solely used when scalping or swing scalping. Swing scalp is something that is my invention, and that is my my word for special way of trading scalps, because scalps are usually 5 to 10 pips and swing scalps can be anywhere between 10 and 25 pips. So that is what I have invented myself, swing scalping. And I use, of course, hourly pivot points plus 5, 6, 7 pips above it on swing scalps, and you can use hourly pivot points when purely scalping. So I think that this is also very important for you to know. Set up charts, entry time frames, and targets and stops based on a trend trades. Okay. Chris, do you have anything to add?
Yeah, I got some things to add regarding trend channels and averages, in fact, on the next slides.
Excellent. So basically, this is, guys, how you should trade a trend and how to find setups, entries, and target prices. Remember this slide. If you want to trade a trend, this is my suggestion how to trade it. And now we don't talk about particular trading strategy. I just giving you basic waypoints to how you should trade a trend. Okay.
Yep. Great stuff there. Great stuff. Oh, wait, you still have one more slide to go here. What is this?
Yeah, this is also one of the things how to trade a trend. Trend is always traded as buy the dips, sell into rallies. So if you want to trade a trend, if you remember our previous slides, trust pullbacks, we will buy pullbacks and we will take profits on trusts. So trend is always traded as buy the dips, sell into rallies. Now I don't talk about breakout trading. So we need to identify pullbacks on higher time frames, as I told you, and zoom into lower time frames. Breakouts are different kind of trading. If we go with a trend and we want to trade a breakout, we will buy into resistance. But we need to be sure that that resistance has been indeed broken and that will collect stops above that resistance. So this is also waypoint. This is not actual trading strategy, but this is a waypoint how a nice and good trading strategy should look. So breakout is traded, a trend breakout is buying into trend on the highs or lows. So if we have a good resistance, let's say today euro had a nice resistance as 35.60, that resistance can also be bought because it was violently broken after 35.62, 63. You saw the price action, so that is called buying into resistance on a retest of previous resistance. It has become a support now. Then also basket trading. That means that we are basically exposing ourselves to euro-dollar currency, but we also trade a dollar pair in its trend. So there is example, euro-dollar, cable and Aussie dollar is a sell trade, then a buy trade is usually dollar-yen. Because dollar-yen moves in an opposite correlation, it's in opposite correlation with those three currency pairs. If you, most of the time, if you buy or sell euro-dollar, British pound sterling dollar and Australian dollar, you are triple exposing yourself to dollar currency. Right, and probably if you are, and that is happening most of the time, if those pairs are in sell mode, the buy mode will be for dollar-yen. So that is called basket trading. You are opening 4 simultaneous orders in the same time in these directions. That is called basket trading, and there is a way of trading which was very, very popular some 10 years ago. So basically a currency basket. That is a collection of currency pairs traded where the sole purpose is to highlight a specific currency move. So if you, as I already told you, if you think that euro-dollar was going to gain strength and wanted to buy a US dollar basket, you will probably take a look into those pairs and use always trend following strategies, because on many occasions you will see that strategy is counter trend, it's a ranging strategy, it's a scalping strategy, but whatever it is, use it, especially if you are new traders, use trend following strategy. If we had chosen to pick the top for today, we would have lost our trades for today on three of those dollar currency pairs: euro dollar, sterling pound, and Aussie. They all move in the same direction, to the upside, and we didn't want to take any counter moves before next level comes into play. I will probably look to sell in between 37 and 37.30 for position trade on euro dollar. Okay. That is what I wanted to say about trend following and how to trade a trend.
Great stuff, Tarantula. So what I still wanted to share regarding the methods, how to define the trend. One of the things I use, for example, as Tarantula as well, is a trend channel. And there's some aspects I wanted to mention, some specifics that I look at to judge whether the trend channel is better maybe than others, or what kind of things am I looking for to judge whether these channels are appropriate. Now, for example, I would be looking at the angle of the channel. The channel would preferably be between a 30 and 45 degree angle. Anything that is steeper on that particular time frame, using the correct market memory, because you have to realize that you can always scrunch the charts on the time frame very, very tight so you see a lot of price data, or you can spread it out so you see 3 candles on the entire screen, right? Well, maybe not that much, but you know what I mean. And the appropriate market data is approximately, for a 1 hour chart, you want to see 2 weeks of price data. And if you're looking at a 4 hour chart, I believe that it was roughly 4 times as much. So maybe 2 months. And let's say a year on the day charts, for example, a weekly chart, probably 5 years. So to give you a rough idea. Now, if you look at proper market memory, then you want to see a 30 to 45 degree. And the reason why is because if you see a steeper angle to it, that's actually just a channel. It could be a trend channel on a lower time frame, but on a higher time frame, it's actually too steep to be sustainable. Because what do we see in trends? We see an up move, a correction, right? A thrust, as Tarantula says, I call it an impulse, correction, impulse, correction, impulse, correction. Price is actually moving up at a higher degree, right? The price could be traveling at perhaps a 70 degree angle, while the correction is maybe 30 or 20 or 10 degree angle. And then the thrust again is at a higher degree angle. So price will be moving at a higher angle, but the entire structure will become a trend channel set at a 45 degree angle, because part of price is fast, part of price is shallower, and the entire structure gets that angle. That's why you want to see that angle. If you see a trend channel or a channel that has a higher degree, then what you're actually looking at is the thrust, the impulse part of the channel. If you see a channel that is too weak, a too shallow angle, well then, in fact, you're probably not looking at a trend, but at a bigger correction. What could happen is that if you have a downside trend, right, for example, or upside, doesn't matter, of course, but you have then a trend like this, technically we're making higher highs and higher lows, and we can even connect the bottoms and tops to make a channel, but the angle is, what is it, 10 degrees, 5 degrees. Obviously, that doesn't have any strength to the upside, and it could be a bear flag on a higher time frame for more downside. It could. You never know. It could always still expand to the upside, maybe before going down or even up, right? There's never, ever a guarantee in the market, but there is a higher probability of this being a correction, in fact, for more downside. Now, what else are we looking for? We're looking for a number of touches. 2 touches is a potential channel, but when you have a 3rd touch, that's when you get the confirmation that it is a trend channel, right? For example, 4-hour chart. What do we have here? Now we have a channel to the upside. We want 3 bottoms touches. We don't necessarily need 3 tops in an uptrend. The opposite is true for the downside. When we have downside trend channel, what we're looking for is 3 touches at the tops. And we have a channel to the downside. The 3rd touch is the confirmation. Now, not always, now I'm going to be talking about this 4th point here, not always does all price action have to fit within that trend channel. You could have some price outside of the trend channel. That's fine. You sometimes get exaggerations of price that push through the tops of an uptrend channel or push through the bottom of a downtrend channel. And Elliott waivers call them overthrows. Maybe other traders do that as well. I'm not sure, in fact, but it's called as an overthrow for Elliott waivers. So what happens then in that case is if you have this channel like that and price is moving up, that if price extends a bit like that, it's still a valid channel. Even the bottom, of course, of that channel, something like that is possible, right? It's not exact math. It's not like 1 + 1 is 2. There's definitely some space here for own improvisation and discretionary elements when looking at this. Obviously, if price fits in that trend channel as much as possible, the better it is. You don't want to have maybe a channel like this and, for example, price here and here and here. Well, no, that's of course exaggerated, and that wouldn't be really a channel I would be looking at, or I wouldn't consider it a trend channel that I would use as a definition for the trend. Let me say it this way. Other than that, price action, for example, where you have a wick outside of that channel, right? Like this, maybe a small wick, fine, right? Fully candles, you know, a group of candles especially, then it's becoming a bit more iffier. But wicks is definitely no problem. Even a part of the candle is fine. Price also tends to respect the middle of the channel. So what you see is that you have the trend channel with the top and the bottom, but if you would put a parallel line right in between the top and the bottom, and some software charts have that the feature that you can put a middle line, you will tend to see that price respects that middle line as well. So not only the tops and bottoms, but also the middle line. And if you put a trend channel on your chart, it would be good to check if that middle line is being respected. And if you maybe adjust it just a bit, you will notice that the price will respect that middle line as a pausing spot or continuation spot or bouncing spot. So what you would see is, if we give again a schematic of this, the middle line here, and price will tend to do something like this. Right? They tend to respect at some point, at least giving a bounce here or respect there. Let's see. Now they also, of course, price tends to move with a thrust or impulsively with the trend and correctively against the trend. We already talked about that. And furthermore, to add to the middle line, we actually even can put quarter lines on the trend channels. I don't tend to do that too often because it's just, you know, visually we already understand that. But technically, you could even look at a trend channel like this and put a middle line in the middle and a quarter line between the middle and the outer trend line, right? Something like that. This is not a nice example, but you get the picture. 5 lines, top, bottom, middle, and one in between. Typically, if you're looking at a channel like this, from a conceptual point of view, you definitely want to be the biggest buyer here if you do get confirmations, however the entry method you use, because of course we have the most space to the top of the trend channel, right? So that's the buying zone. The opposite holds true for a downtrend, where you typically would like to sell anywhere where price is in the upper half, because then you have the most space to the downside. What you want to avoid in an uptrend is in fact buying in the, let me do that again, buying in the upper quarter. Why is that? If you're buying in the upper quarter, obviously you can see that the space to the upside, what we could expect at least and plan on, is very limited. Plus, sometimes the currency doesn't even get to the top of the upper trend channel or move down to the lower bottom, the lower trend channel line, because there's no thrust or power anymore to push price to that level, and the weakness could definitely enter the market already at, let's say, the 3/4 line here, or maybe just above it, but not able to reach the outer zone there. So buying in that area is very chancy and not good, because you're really buying in front of resistance, too much in front of it, and opposite for the downside. So here's an example of the AutoCAD daily, for example, where you can see a nice uptrend channel spread out over a long period of time. And all these elements that we've talked about coming back into this example. And you can see prices respecting here. I mean, I've seen better examples of price respecting the middle line, to be honest, but still, anyhow, you can see how the thrusts and impulses move here to the upside. You do see the quarter line here, right, being used. Also the 3/4 line here being respected with some overthrows. A nice, neat bottom. You can draw these trend channels, in fact, by just clicking on this E button right in here on your Admiral Markets platform and taking the bottom or top and connecting it to the next one. And then you have a provisionary channel, right? And then the next one will be the confirmation. Obviously, if you connect these bottoms like this, you have a trend channel as well. But as we already indicated, that channel is a steep angle. Look at that angle. That's maybe, what is it, 50, 60 even? The reason why that's too steep is because price can't keep going at that pace, because it would be unsustainable, right? It would go to the moon. It needs to correct itself to give an angle at which price can move up at a sustainable rate. And this part of that is a typical example. And what you will often see, I forgot to mention it, in fact, it just popped in my mind right now, is at the very beginning, when the trend is changing from maybe down to up or up to down, doesn't matter, you will see, of course, a break of the downtrend lines and the downtrend channel, price breaking through that. You will see divergence between the bottoms, and you will see some signals that price is, of course, breaking to the other side. What you often see, though, is a typical behavior at the very beginning on a lower time frame is up, deep correction, up, deep correction, up, deep correction. And you have a channel like this. Often enough, it's a very tight, narrow channel. But if it is to become a wider, more bigger real trend channel, keep an eye on the top line, because if actually the bottom, if the bottom line gets broken, actually it probably could be a bear flag. But if the top line gets broken, what you'll see is that the channel gets expanded, and you'll have a wider trend channel. And in fact, the former top line often becomes the future middle line, and the whole trend channel gets expanded like that. All right, so that's often enough you see something like this at first, and then once you break through the top line, you know that in fact the currency is becoming more impulsive, more thrust. Alrighty, the little triangles are fractals, and they just indicate support or resistance, because the price stopped there and price couldn't break below the low or above the high for 2 candles. So it's an easy tool to see support and resistance. All right, so that's regarding trend channels, what I wanted to share. Some things regarding moving averages. And of course, definitely there are differences in which moving averages are used among traders and which type of moving averages. But in general, we can classify some characteristics that I wanted to share with you. And basically, we're looking at a difference between price and moving averages. All right, so the more price is expanding away or moving away from the moving averages, obviously the more thrust it is showing. Also, the difference between the moving averages, most of the time a short-term moving average, an intermediate moving average, and a long-term moving average, for example, would be good, because then you can see when the short term is moving away from the intermediate and the intermediate is moving away from the long term, that obviously price is pulling those moving averages away from each other, and the currency is in a trend. Also, the angle of the moving averages, here too, a way or measurement of looking at the trend. And price crossing over moving averages is important as well. And last but not least, watching which fractals actually touch the moving averages. And I'll dive into that a bit more, because that, I think, is a very interesting thing that I want to share with you. Basically, these are just things you can look at. For me personally, what I'm looking for in a trend is if the short, at least the intermediate, price is above intermediate and intermediate is above the long moving average, because that's really where the trend is very nicely in motion. And what I use as an intermediate, and most of you who are in the live trading session more regularly know that I use a 34 EMA close, and the long term I use 144 EMA close. So what basically happens, if price is above the 34 EMA, we're in a trend, obviously. But if it's still below the 144, then it will bump into that long-term resistance, and that could be either a reversal point or retracement point. So let me give you a drawing here, because I'm using too many words maybe. If price is under, doing like that, and we have intermediate moving average and a long-term moving average like this, what I mean is that obviously this is a downtrend. Simple. What I also mean is that if price then breaks above the intermediate, this swings up. This could be considered on a 4-hour chart already a significant reversal, and could be considered an uptrend already on that time frame, but we must realize that there will be resistance at that long-term moving average. At that spot, we could see a continuation of the trend, and this was just a bigger retracement, or we in fact make a reversal. So it's at a talking spot, if you like. All right. Now, obviously, if price is bouncing around and the moving averages are bouncing around, there's no trend. And yeah, that's, I think, the main thing I wanted to share with you. Now, regarding those fractals, I'm going to explain that actually with using this screenshot. And this is the Euro-Dollar 4-hour chart of, I think it was earlier in the summer this year. And I'm not sure if these are two different moving averages. I think this is, I'm not so sure, in fact, what these are. But in any case, I should have used the 34 and 144 example. But in any case, what I mean is I think that this looks like a 34 to me, but doesn't matter. The point is that what I look for is a fractal that's touching the 34 EMA. And why is that so? Because any fractal that is above the 34 EMA in an uptrend is actually a fractal which is extended way above the average. Let's take an example of this fractal. That fractal is not a key fractal in my definition. Why? Well, if that fractal gets broken, we technically have a lower low. Does that mean we're in a downtrend? On this 4-hour chart at least? No. And the reason why is because the fractal itself was above the moving average. So that's not the key moving average. I consider the key moving average the one that is touching the 34 EMA, because that is the key support. Any fractal that doesn't touch it is really a fractal that it doesn't have that same significance, because price could still retrace to the 34 EMA and then bounce. All right, so let's see if we have some example here on the downside. Let's see. Well, actually, the downside, ironically, is quite neat with all its lower lows and lower highs. Maybe not the best example. Here's an example, in fact, of the upside. Here's a fractal. Is that a key fractal? No. Is this and this one a key fractal? Yes, right? Because those are touching those moving averages. So I hope the point is clear. If it's sailing too high above the 34 EMA, well, you know, it's not significant. You could even use the same methodology for the 144 EMA when price retraces that deeply. The fractal that touches the 144 EMA becomes the key level of, you know, whether the currency retraces or reverses. Obviously, this is not a 100% guarantee. Sometimes, even if the price traces through the 144 EMA fractal, you don't always get a reversal, but this is in most cases true and my definition. So that's how I use moving averages as a support, because the advantage of moving averages is the fact that they're always there. They always will give a support level in an uptrend, and there always will be a resistance in a downtrend. But the thing is that you don't have, with the advantage of a trend channel is that you have the support and a resistance in an uptrend. So you have both sides of the story. Of course, you don't have that with moving averages. You only have one side. The trend channel has both sides. That's the advantage of a trend channel. You could compensate that lack of or disadvantage by using multiple time frames with moving averages, because what will be support on the 4-hour chart, if you go to the day chart, maybe there's a moving average on the daily chart coming in from the tops that would be resistance. So by switching with time frames, you could compensate the lack of one side of the story for moving averages. The advantage, though, of moving averages is that they're fluid. They will accommodate price a bit more. They're more flexible, adjustable. As you can see, the rate at which this moving average increases is not the same, which means it will hug price and adjust to it a bit. if you were to use a trend channel, in some cases really, trend channels are not always really that useful because there is just not a trend channel that really fits that well. Price doesn't just like fit within trend channel that would meet certain requirements, in fact. That's why having multiple channels, in fact, is good. There's nothing wrong with having 1, 2, or even 3 channels and multiple trend lines. There's no rule saying you can only have 1 trend channel or on 1 time frame. You could have 2 on 1 time frame and another one on another time frame. Right? Nothing wrong with that. Or you can do something like that. You can have a steeper trend channel and then have a shallower one, right? The steeper one is kind of the trend channel that shows the entire price action, while maybe another trend channel could show more recent price, right? Obviously, we had a down impulse here, downside here, but recently here you can see there was a more weaker, shallower angle. So by putting a trend channel on that, you could capture price movement like that as well. And when we break out here, it actually signals a further continuation of price and a further acceleration of the downtrend. What I look for regarding the touch, that's a very good question, in fact, from AG. For those of you who know, I use 3 34 EMAs, in fact, the close, the high, and open. So what I'm looking for in an uptrend is the fractal that touches the lower 34 EMA, 34 low, and in a downtrend, I'm looking for a fractal that touches the 34 EMA high, the upper one. The upper one, and in a downtrend, the lower one, or anything a bit lower than that. So if it touches the middle one, then I mean, this is of course a gray area. I'm not saying it's not totally not important, but the theory is really the lowest and the highest, or below above it. Alrighty. Sorry. Oh, well, that wraps it up, I guess. I thought I had one more slide, but I guess not. So this is the 4-hour chart on the euro. And, well, let me quickly show you otherwise a chart here. Maybe we can use this euro as an example. This is the 4-hour world, right? And I don't have all three EMAs at the moment. Let me quickly, I can add 2 of them. High and low. Alrighty, so here we got the 3 moving averages. So what I'm looking for basically is, you can see, well, sorry about that. You can see that price is below the band here, and this is a downtrend, right? Then fights above it, finds resistance as the long-term moving average, doesn't get the reversal, but you get, doesn't get the retracement, but you get the reversal to the upside. We stay above the band, and every time we touch more or less the lowest, right, that's the key, right? The key fractal right there. Key fractal, key fractal, key fractal. When we break that, you can see we make the retracement down to the long-term moving average, right? 3 times. And now we recently bounced off, and that's why definitely there was there was that chance that we would break. I agree with Tarantula that the thrust of the break is something that was more than I expected, but still, yeah, you can see that we couldn't break the support, and this was a correction, and it turned out to be a retracement back to the moving average instead of a reversal. So can you put a trend channel on this? Well, you could have put a channel on this side, obviously on a 1-hour chart, but that was a very steep channel, right? Maybe we can give it we can use that as an example. Maybe let's scroll back a bit and do something like this, right? So that would be an example of a channel, maybe on the 1 hour chart. You know, we had a bit of an overthrow here. That was the FMOC that punched it through. Let's see, the trading room, by the way, is starting at 8:45 your time AG. It's 8:45 Central European time, or 7:45 UK time in the morning, AM. Let's see, we have one more question. Low-range Asian sessions may skew trend detection on 1 hour charts or similar time frames. Are there adapted methods for interpretation of indicators? Asian session may be flat insertion in the middle of the clean trend. Yes, that would be 8:45 then indeed for you, AG. Well, I think that basically these types of corrections give that angle in a way to a trend, isn't it? Because that's actually the consolidation zone that allows the currency in a way to catch some breath before it continues. It needs to catch a breath a bit because nothing moves in one straight line. Everything needs a correction. So maybe it could happen that a 1 hour chart, a trend channel is broken because of the choppiness and consolidation in the Asian session. I guess one of the solutions is just to adjust the angle of the trend channel, or otherwise use moving averages in that case. Otherwise, I wouldn't know. I think those two probably be the best. We're approaching the minus 272, by the way, of the euro. So, well, I guess let's see if there are any questions that someone would have to ask. And otherwise, I guess we'll wrap it up.
Most of the questions I already answered. But guys, if you have any other questions, do not hesitate to ask us. So most of the questions have been answered, sorry.
Exactly.
There is a question now. What about basket trading with euro dollar and dollar Swissy or euro Aussie and Aussie Swissy? I don't do that basically. I just gave an example of basket trading, and if I did that, I would do it with above mentioned crosses, not with Aussie, Swissy, and other currency pairs. Basically, I would stick with dollar and dollar yen. What happens if you're not greedy? If you're not greedy, then you're needy. Joking. Well, if you're not greedy, probably you will save your account. You will become a full developed trader. My forum is Forex Factory Spiders Den. Okay, Aussie, okay. This webinar is being recorded and it will be uploaded on Admiral Markets website under webinars, recorded webinars. Try to look at webinars on Admiral Market site and you will find it recorded there. So you can watch it later. So if you don't have any further questions, we can conclude the webinar. I think, Chris, there are no questions. But surely we answered most of it, at least 95%.
Indeed. There's one more, in fact, for you here.
Mm-hmm. Which one?
What is a realistic goal for a newish trader?
Realistic goal?
Yes.
Okay.
Per month.
To be honest, guys, a realistic goal for a new trader is not to lose the capital in first 6 months. After the 6 months, try to be a break-even. After you try to be positive. So, if you ask me, newbie traders should concentrate on not losing the capital. That is proper risk management, and after that, there will become profits. But try not to lose the whole account in the first 6 months. That is the most realistic goal. Not to lose the account in the first 6 months. Because most of people I know, most of traders who I know begin with burning their accounts. So try not to do that. Or at least practice demo trading, but practice it how you would do on the real account. So you will get a bit of a feeling how is to trade on live account. But do it. Try not to involve emotions in both the live and demo account, but try to money management demo account as you would money management a real account. Okay. There is a question for you, Chris. What are 3 MAs you applied for?
Oh yeah, the high, low, and close 34 EMA. And indeed, the EMAs I use personally are 34, 144 EMA, and the short-term one, either an 8 or 13. That sometimes varies. Not always do I use a short-term one, in fact, as you might have noticed. But if I do, then it's one of those. And of course, this is just a setup that I use. I use it because of the fib numbers, and I like them a lot. I got used to them, and I've worked a good understanding of them. But I know that definitely others use, for example, the 50, the 100, the 200, or other combinations, right? No, the 34 EMA high, low, and close, all 34 EMA, and the 144 close. Great. Well, we got next week again. We got let's see, trading webinars with Tarantula. In fact, I think on Monday, and we got trading live trading rooms on Tuesday, Wednesday, Thursday, and of course this webinar next week, same time, same place. So yeah, I wish everyone a great weekend. In fact, for those of you who I might speak on Monday, I'll be speaking or giving a presentation on Monday through Animal Markets. So may see you on Monday, in fact. Otherwise, wish you a great weekend, and thanks for being here.
I also wish you a great week, guys. Thanks for being here with us, and be sure to visit my session recaps, live webinars with Chris, and our mutual webinars. So have a great week, great weekend, and many good tips to you all, guys. See you soon and hear from you soon. Bye-bye.
The organizer has ended the